Hi there, this is Michael Kramer of Mock Capital. Today is Tuesday, October 28th, and it's around 4 o'clock New York time. So it's another week of government shutdowns, which means we don't have a lot of economic data to go over. However, we will be getting a Fed meeting tomorrow, and it is expected that the Fed will be cutting interest rates to 3.25% to 4% from 4% and 4.25%. There is no summary of economic projections at this week's meeting. One thing that may catch people's attention is whether or not the Fed decides to end quantitative tightening here in the U.S. Recently, we have seen some pressures in the overnight funding market where rates have been climbing, and that's due mostly to the drainage of liquidity that we've seen on the Fed's balance sheet over the course of the last several months. And so there are some people speculating the Fed may choose to end quantitative tightening. There are other people who are saying it may not come till December or later next year. However, at this point, it's really hard to say if the Fed were to end quantitative tightening at the October meeting or the December meeting. It probably doesn't make that much of a difference over the very short term. But again, it's just something that you should be aware of in case you start hearing people talking about quantitative easing. Although this isn't, if the Fed does do anything, it's likely to stabilize the balance sheet, not expand it. And so because it's not expanding, it wouldn't be quantitative easing. There isn't really much else when it comes to economic data coming this week. We would have been getting PCE reports and GDP numbers, but of course the government is closed, and so that we're not going to get. However, next week we will be getting ISM data on November 3rd. That's the Monday, so that data will be coming, and there will also be an ISM services data point later that week as well. It's also important to point out that we will be getting an ECB meeting on October 30th, and we will also be getting a BOJ meeting on October 30th, and those both could have pretty big impacts on where some of these currency markets go. We've certainly have seen the euro really stabilize around this 116 area. Obviously, if we get a Lagarde that kind of continues to hit home with this idea that the ECB is done cutting interest rates and that the disinflationary process is over, it could really be enough to push the euro higher versus the dollar, potentially sending it back towards the 117.7 area. If you get a more dovish Lagarde, it could push the euro down towards 114. I mean, at present, from what I understand and what I've seen, it sounds like the ECB has pretty much agreed that they're done cutting rates, and inflation has largely stabilized in Europe, so there may be no need to cut rates further. And if it comes across at the Fed meeting that the Fed may be more on the dovish side of things, it's a good reason for the euro really to rise and strengthen versus the dollar. And so one has to be mindful that a breakout above 116.5 could lead to the euro really rising back towards that 117.7 to 118 region. The British pound has really continued to also be very weak versus the dollar, and it's largely trying to stabilize around this 133 area, although just more recently we have seen it break down. Momentum in the pound is very bearish and suggesting that the pound continue to weaken. You can clearly see that there is a notable trend lower in the pound currently on the RSI, and we are currently trading what looks like below a support level at 133.30. So at this point, I think there's a good chance that we may see the pound actually trade lower towards this 131.70 region, and that's likely to be where it finds support, at least for now, unless something happens between now and next week that should cause that to change. Right now, I'm thinking that this is probably where we're headed. Also, when we look at the yen, there's been some speculation that the BOJ, even though it's not going to be changing rate policy this week, it could be starting to feel a little bit of pressure from the markets, really, at this point, that it may need to actually begin to raise rates again. We have seen the yen really weaken fairly materially, and it's back into the 152 area, which isn't put it at the highs, but it certainly puts it towards the higher end of the range of where it's been historically. So at this point, they still have an inflation rate running around 3%, and it seems inevitable that at some point the BOJ is going to have to raise rates again. Otherwise, I think the yen really risks going really weakening significantly versus the dollar and probably pushing up to this 154.30 area. If we were to get a BOJ meeting that comes across as slightly more hawkish, indicating that there's a good chance that we may see a December rate hike, then it's possible we could see the yen try to fill this gap created around the 148 area. You can see that there appears to be what could also be a double top pattern forming with your neckline there, and that could lead to the yen breaking support and also filling the gap. So a couple of things to watch for. The RSI is clearly trending up, and that would kind of tell us that maybe the yen weakens versus the dollar. But again, that's going to depend a lot on what the BOJ has to say at this meeting and whether or not they're going to start to fold some of the pressure on the markets to raising rates. We've seen gold really come down pretty sharply since the last time we touched base, and right now we're looking at a scenario where gold is now trading below the 20-day moving average. We're also trading below support at around 4,000, and that sets up a good potential that we could see gold move back down towards around 3,800 or so. That's where the lower Bollinger Band is. That's where the 50-day moving average is. You can clearly see that the RSI has been slipping, and I think more importantly than anything is that we've been seeing implied volatility for gold coming down sharply. And so it looks like whatever the squeeze was that was taking place in gold appears to be over. And I think that given that you're seeing implied volatility on gold coming down, it's telling you a lot that buying demand has basically kind of dried up. And that's, I think, largely what's driving the price of gold lower. When we look at silver, it too has also broken some pretty important levels of support. You can certainly see, though, it's closer to its lower Bollinger Band than gold at around 45.5. Here's your 50-day moving average, also around 44. So it's possible that silver could actually be forming and finding some support in this 45.30 area. Maybe it even sets up a rebound back to 48 or so. It's not really entirely clear at this point because, again, when we look at implied volatility on silver, we're seeing also the same thing happening. And so, again, it just looks like whatever was really responsible for pushing silver and gold prices up and a lot of these commodity prices up seems to really be fading. And so I would think if implied volatility continues to come down in these names, you can continue to see some weakness developing for them. We've actually seen the FTSE push higher and move up to about 9,600, which is, I guess, a bit surprising to me, only because we know that really the FTSE has traded a lot with copper, and it continues to do so, and we have seen copper actually continue to strengthen a little bit, and so that's where the surprise is because we've been seeing metals like gold and silver get hit really hard, but yet copper kind of remains pretty steady, and I think that goes to the fact that copper has just more industrial uses than gold and silver, although they're both used a little bit for industrial purposes, certainly not to the extent that copper is. And so that could be one of one of the main differences between them and why you're still seeing copper hang in there, and so you're continuing to see really the FTSE continue to march higher. And you can also get a sense that right now, though, we are getting overbought on the FTSE. In fact, we've seen the index rise above the Bollinger Band, and we've seen the index also push above 73 on the RSI, suggesting that we really should see a period of consolidation sideways or see some sort of pullback to the 20-day moving average around 94.90. Given the strength that we've seen in the FTSE, a sideways consolidation seems like the most reasonable expectation. The DAX has also really been continuing to do a whole lot of nothing. The DAX has now been stuck in this trading range going back to May, and right now it finds itself right on the 20-day moving average, right in between the middle of the two Bollinger Bands, right on support at 24,300. And I mean, you can clearly see here the DAX has been trying to it's been losing momentum. It tried to regain some, but that really didn't work. And so, again, we failed now 4 times up at this 24,850 area. We certainly had a very viable opportunity and chance for the DAX to break out, and instead we broke down. And so it's kind of leads one to believe that maybe we're going to try to test this 23,750 area and maybe even test this 23,400 region before this is all said and done, and then we'll have to revisit this again. The NASDAQ has also continued to power higher, much like the FTSE, although the NASDAQ now can officially be termed in being overbought territory. Now 2 days completely above its upper Bollinger Band, RSI up over 70. It would seem to me that you would deserve to have some sort of pullback or sideways consolidation in the NASDAQ. I wouldn't be surprised with big tech earnings coming over the next couple of days that you could see the NASDAQ actually pull back to the 20-day moving average and test that 24,990 region. The S&P also moved up today. Again, you have 2 days above the upper Bollinger Band. You're basically at overbought levels with an RSI of 69. Interestingly, this trend line, you can actually draw it all the way back to the origins down here on the March 20 lows. So maybe it has some significance, maybe it doesn't. It's just something I thought I would point out. But again, for the most part, you're overbought here. A period of sideways consolidation. A move back to the 20-day moving average certainly seems reasonable at 6,700 or so. Again, the market at this point on the S&P looks completely overextended. It's really the same thing with the Dow. Even potentially putting in this looks like a reversal candle possibly. You can see also above the Bollinger Band now 2 days in a row. RSI also approaching 70. Again, a pullback to the 20-day seems like a reasonable expectation over the next couple of trading sessions. But we'll just have to see how things go, because obviously there's a lot of news flow going and things can change very dynamically. Anyway, have a great rest of your day, and we'll see you next week. Bye.